This video is a video response given to someone who asked me, hi Watson. Can I show you? I know you guys haven't seen him in a while, so here you go. Give him a kiss. So this is a video response to someone's question who asked me a question on Hey Hero. You can ask me a question there too if you want a video response. The link is down below. I've done a video like this before and I've released it on YouTube, and I said the responses are probably gonna be 5 to 10 minutes. That is straight up impossible for me. I just get lost in the sauce. I talk forever. So if you ask me a question there, it'll probably be 15 to 30 minutes long. So our man Joe, who you've met before, and the last time I did this, is asking about credit spreads and how he can use them to make money as QQQ, the NASDAQ ETF, aka the Qs, goes down in value. So I just gave him a bunch of little pointers and some not so commonly talked about things relating to credit spreads to help guide him into how to utilize credit spreads effectively, specifically referring to using a call credit spread to make money as the Qs go down. So all of that said, enjoy. Joe, my man, how are you? It is good to see you through the lens of my camera. So we're talking about credit spreads. Credit spreads, or any spreads in general, are going to be almost by definition innately more difficult to manage than something like the wheel strategy. The wheel strategy can be so easy to manage unless you sell a put on an underlying and get assigned and you buy 100 shares and the stock just keeps going down. So if you're completely wrong in the long term about the underlying stock, then you can be screwed. But all other outcomes can be totally foreseen and you can be okay with it. Credit spreads, on the other hand, you can't just lose. You can just lose money, and that's just that. You're either right or you're wrong, although there are ways to manage your position, which we'll talk about here in a minute. So we're going to take a look at QQQ. So we can short the NASDAQ in a sense, make money as the NASDAQ goes down. To do that, we would sell a call credit spread. When you're selling a call credit spread, you are going to be bearish on the underlying stock. This is because you sell a call that is closer to the money, so closer to being at the money or in the money, and you buy call that's further out of the money. This short call is bearish. It has a negative delta. This long call is bullish. It has a positive delta. However, this negative delta of your bearish call is larger than the positive delta of your bullish call. So overall, your position is going to be bearish. So if you want to make money as the Qs go down, you would sell a call credit spread on the Qs. Something to keep in mind, and this might be kind of tricky at first if you haven't heard this before to wrap your head around it, but I'm just going to go ahead and spew it out to you just in case you can retain any of it. It is kind of useful and good to know. At-the-money options have higher extrinsic value, and I think you probably know by now, but that is the portion of premium given to an option based on time to maturity and implied volatility. At-the-money options have a larger extrinsic value than out-of-the-money or in-the-money options because there's a lot of uncertainty with at-the-money options. What determines an at-the-money option's fate of whether or not it becomes in the money or not is going to be volatility and time, and that's what constitutes extrinsic value. So at-the-money options have more weight given to implied volatility and time to maturity or time to expiration than out of the money or in the money options. So it has a larger extrinsic value. That said, anything that has a large or that extrinsic value has to decay off by expiration. So it decays pretty consistently over time until the last 30 to 45 days. So if at-the-money options have a larger extrinsic value that has to decay consistently over time, it is going to have a larger theta than out of the money or in the money options. Now it has a larger theta. It might be a smaller percentage of the overall premium. So if I bought one at the money option and then bought a bunch of out of the money options that had the same value of this single at the money option, I would have an overall larger theta over here. But when we're looking at just individual options, at the money options will have a larger theta. So that said, in addition to this, at the money options also have a larger vega because, like I said, they have a larger extrinsic value, which factors in implied volatility. There's more weight given to implied volatility for at-the-money options. So the vega is going to be higher for at-the-money options. Vega is how much the options premium changes given a 1% move in implied volatility. So that said, those two things said, at-the-money options have a larger theta and a larger vega. So when you're looking at a call credit spread, whichever leg is closer to at-the-money is going to determine whether or not you have a positive or negative theta and a positive or negative vega. So for a call credit spread, you have a short call that's closer to being at the money. That is going to have a large negative vega and a large positive theta. The exact opposite is true for your long leg up here. It is going to have a smaller positive vega and smaller negative theta. So overall, if you look at the Greeks of these two options, your strategy is going to have a negative vega and a positive theta if your short leg is closer to at the money. Okay, so whatever leg is closer to being at the money is going to be the driving leg. Its Greeks are going to determine, as far as theta and vega go, determine whether or not you are long or short volatility, or if you are making or losing money as each day passes. So if your short leg's closer at the money, you are making money as each day passes because you have an overall positive theta. So that's something to keep in mind, because generally speaking, we are going to be selling credit spreads out of the money because they have a higher probability of success. You won't right off the rip be at risk of assignment. So when you do that, you're going to have a positive theta and a negative vega, which is important to know. It's important to know because, one, it's good to know that you're making money as each day passes if things trade sideways due to theta. And two, because you have a negative vega, you're short implied volatility, and that means you want to sell implied credit spreads in high implied volatility environments. In high implied volatility environments, when implied volatility is high relative to the historical implied volatility of the underlying options, it is more likely to revert back to the average implied volatility for those options, historical average, than it is to keep expanding. That's called mean reversion, and that is a characteristic that we want to take advantage of when we're trading credit spreads. So when you have a credit spread whose short leg is closer at the money, sell in high implied volatility environments such that when implied volatility goes down, you will make more money. So you're not only betting on the underlying stock going down, you're also betting on implied volatility going down. And this is especially important with credit call spreads because when the underlying stock price decreases anywhere with any stock, there is a tendency, it's not always true, and the reasons for this I'm not going to go into, but there's a tendency for implied volatility to increase. So we want to make sure that we are putting our call credit spread in the highest implied volatility scenario possible to give us the best edge possible because of the tendency for implied volatility to continue to increase if the underlying goes down. So what I mean specifically is if we sell in really, really high implied volatility environments, even though there's a tendency for implied volatility to increase when the underlying price drops, if we're selling in really, really high implied volatility environments, that tendency is, I guess, curbed a little bit. That may not be possible with the Qs, and it's a good way to give yourself an edge, but you don't necessarily have to do it that way because you will definitely still make money if the underlying goes down. But it is a good way to give yourself an edge, and if you want to get the probabilities on your side, then you should be looking for an edge wherever you can. When your short leg is closer at the money, that is the case. You're short implied volatility, and you're making money as each day passes. If your spread becomes in the money, it becomes flipped. You're losing money every day as each day passes because your long leg's theta is larger and vega is larger. And you're also going to be long volatility. But most of the time, we don't want our credit spread to get in the money, and we'll probably roll our credit spread if it does. So 99% of the time, your credit spread is going to be out of the money, hopefully, and you will be short volatility and be making money as each day passes. Okay. I know it's kind of dense. I hope you didn't mind me rambling. I'm just trying to give you as much information as possible because I know you can rewatch this. As far as how far out of the money to sell call credit spreads or any credit spreads in general, it really depends on your outlook. Obviously, the further out of the money your credit spread is, the more likely you are to make money. Because as long as it stays out of the money, you can let it expire worthless and you'll never have to pay back any of the credit you initially received. But the problem with that, though, is you might be collecting just a few pennies here and there because it's so far out of the money, the options are not worth very much. But your max loss is going to be pretty high. So the higher the probability of success, the higher your max loss is going to be. So it's kind of a trade-off there. So people who try to pinch off a few pennies here and there might be successful because there's a really high probability of success over 6 months. But then on one trade, things go against them and they lose all the credits they've earned so far. So you need to be aware of that so that you're not just trying to... Credit spreads aren't entirely a probabilities game because you also have to have a sentiment on the underlying because you can try to play the probabilities as much as possible. But if you don't give yourself an edge as to like researching the stock and having a good understanding of where the stock or underlying is going to go, the probabilities are going to play themselves out, which means 99% of the time when you're selling out of the money, yeah, you're going to make money, but at one time you could lose all the money you put into it. Okay, that happens all the time. It's called collecting pennies in front of, or nickels in front of a steamroller. That's selling out of the money credit spreads. So you have to have a firm thesis on why you think the underlying is going to go a certain direction, and if you're wrong, there are ways to manage your position, to manage any losses. Let's talk briefly about, let me continue on that. So the further out of the money you sell your call credit spread, the higher probability of success. Okay, but if you're going to sell it way out of the money, that means you're really unsure of where the underlying is going to go, and you can have a high probability of success. I wouldn't keep repeating it because you'll probably be right the first time. So if you want to collect a few bucks, fine. But if you just keep selling it way out of the money because you don't know where the stock's going to go, eventually it'll probably come back to bite you because your max loss on high probability of success trades is going to be rather large. So have a good idea of where the stock is going and why, and believe in yourself there, and also diversify your portfolio among a lot of different trades. So that said, since you have a generally good idea of where the underlying is going to go, you did your research, let's say you think it's going to go down because you should think it's going down if you're selling a call credit spread, then don't sell super far out of the money if you have a good thesis. Sell kind of out of the money to give yourself an edge to increase your probability of success, but not so far out of the money that you're only collecting a few pennies. And you want to, in this case, it's not just about deciding, well, if you're, slightly bearish, you'll sell a little bit out of the money. If you're really bearish, you'll sell closer to at the money. While that's kind of true, you also have to take a look at the profit and loss payout for the spread depending on what strikes you choose. And to do that, you should use optionsprofitcalculator.com. So for example here, I'm looking at QQQ, the Qs, and I have a call credit spread open here. Our net credit is 41 cents, and our max loss is $59. And you can see that, let's see, maximum risk right here is $59. And that is if your short leg gets in the money at expiry. So $59 is your max loss, and that happens in one of two cases. If the underlying stock rises really far, you can hit your max loss, and you can buy to close for your max loss of $59. Another scenario, and it's synonymous really, is if your spread gets in the money and you get assigned, which could happen any day prior to expiration. It's more likely the deeper in the money that spread is, and the closer to expiration it is. Sound familiar to selling calls and puts? It is almost guaranteed to happen if your short leg is in the money at expiration day. At this point, I'd like to mention that there are some risks to holding spreads into expiration, especially if the stock price is hovering around your strikes. So I'm going to link a video down below that goes into detail on those risks because they are significant. So you don't always want to hold spreads into expiration unless the stock price is pretty far away from the strikes, which means stock price is below your short leg significantly. So this payout is going to change depending on what strikes I choose. The further out of the money my short leg is, or the whole spread is, the less credit I'm going to receive, the higher my maximum loss will be, but the higher my chance of success. The closer to at the money you sell your credit spread, the higher your credit will be, the lower your max loss will be, but the lower your probability of success. But if you can somehow find yourself an edge on where you think the underlying is going, then it is more beneficial to have a smaller max loss and collect more credit. Let's see here. So, when it comes to assignment and your max loss, there's a way to calculate it, and the way to calculate what happens with assignment is found in my credit spread tutorial. I will link it down below to the spot where I talk about assignment and what that means for you. It means you will end in a loss, right? Max loss and what happens when you are assigned, they are synonymous. If the underlying goes really high up or you get assigned, the max loss is the same. And I will link to a video down below explaining that. If you do get assigned, what happens is, your short call, the person on the other side exercises, so you sell 100 shares at the strike, and then your long call should automatically exercise if it's at expiration. If it's before expiration, you may have to manually do it, and you will buy 100 shares at the strike. So you'll sell 100 here, buy 100 here. Since you're selling at a lower price than you have to buy to close those shares at, you are losing the difference as a loss, although you do get to keep your initial credit. But I'll discuss that in the video down below. So it's up to you how far out of the money or close to at the money you want to sell it. Use the options profit calculator as a tool to map out what payout diagram best fits your thesis for the underlying stock and your risk tolerance and overall goals for the trade. It's up to you. I can't tell you where to sell it. You know, I can't tell you where to sell it. It is up to you. The more bearish you are, yeah, probably closer to at the money, you should sell it. Another way to, maybe you want to increase the risk of the trade. Like you're kind of happy with the ratio between profit and loss, but so you're happy with where the strikes are, but you want the numbers to be bigger. You know, if the ratio is 1-to-1, but it's $50 max profit and $50 max loss, but you just want more of that on each side. So it could be 100 and 100 or 200 and 200. A way to kind of do this is to distance the strikes from each other. So for example, if I come here, we can see my max profit. Let's see. Maximum return is $41, which is the initial credit we receive. Maximum risk is $59, which is if we get assigned, or if the stock price is above our short leg by expiration. If it goes much, much, much higher than our short leg before expiration, we can also hit our max loss as well. You can see that by the -100s here. But generally speaking, we just want to keep the stock price below our short leg as much as possible. So if I distance these legs out, and maybe I think the stock price is going to stay below 293, so I'll leave my short leg right where it is. But I can move my long leg, the 294, out to 295. So let's do that really quick here. 295. We'll do the mid price. Hit calculate. So now my maximum credit is $77 and my maximum risk is $123. So it's a good way to increase your risk to increase your profit while keeping about the same probability of success, right? About the same. So that's how I would increase risk for increased chance, increase your risk for a potential increase in profit. You know, maybe you don't want to just make $55 and you don't want to have to open a bunch of spreads, because if you're selling to open a bunch of spreads and then buying to close a bunch of spreads, you're likely going to pay at least some of the bid ask you're going to pay some of the bid ask in the process for each of those spreads. So you're going to be losing a few bucks out the window for opening and closing a bunch of spreads. So it's much better, in my opinion, to just put distance between the strikes and just sell to open one spread. And keep in mind that the general goal is to keep the stock below your short leg of a call credit spread to avoid your max loss and avoid assignment. So let's talk about, let's open up a spread on the Qs and talk about managing your position. And we're going to do this exact same spread on Robinhood. November 20th at the top, make sure we'll do buy call first. So we're going to buy or call and tap select in the top right hand corner so that you can select multiple options. So we'll tap that. And what do we have here? We've bought our 294 call. So we'll tap on that guy. We'll switch it over to sell. So sell call at the top. And we're going to sell the 293 call. All right, so the credit's going to be about $39. And our loss is going to be similar to what was shown here. Our max loss of $59. It'll be around there. Maybe a little bit different depending on what credit we get, but pretty close. We'll hit review. We'll do 1. If you want a faster fill, you choose a cheaper price because we were selling to open. We were net selling. Our short leg is the driver of the strategy because it's worth more than our long leg. So we are net selling. And that negative delta that drives our bearish position on the underlying stock never changes, no matter whether, if it's closer at the money, it's out of the money, in the money, whatever. It's always a negative delta. The only things that change, only Greeks that change depending on where your strikes are relative to the money, being at the money, is Vega and Theta. So let's go ahead and send this off. We'll send it off for 39 cents and see if we can get a fill. And you saw it said for a second there. Here, I'll replace order so you can see it again. So we'll do 39 cents. So it says collateral there, $100. That is what goes out the window if you get assigned. Because the width of our strikes is 1 point. If I get assigned and sell 100 at my short call and have to buy to close 1 point higher, I'm losing $100. So Robinhood takes aside $100 and holds it aside as collateral in case you do get assigned, so you can for sure pay for that loss. However, that is not your max loss because the credit you initially receive is yours to keep if you get assigned. You never give it back. So if I collect a $39 credit, it's going to be a $61 max loss. Okay, you keep the credit, but your strikes are 1 point apart, and if you get assigned, you're going to sell 100 at this strike, and buy 100 1 point higher, losing $100 in the process. So 100 minus 39 is $61. So that will be our max loss. Okay, let's go ahead and send that off. And this is what I mean. I'm not getting a fill and I'm not being very patient. So I'm going to enter a pretty cheap credit. And if I had a bunch of spreads, instead of lengthening my strikes, if I had a bunch of spreads where I'm selling pretty close to the bid and then later we'll buy to close at the ask price, I'm giving up the bid-ask spread. And it can get kind of costly if you have a bunch of different spreads. All right, so we have our Q's credit spread open. So as this is open, the payoff, your profit and loss is going to change, and it's going to change very similarly to how it's shown on this chart here, where you can choose a certain day and a certain stock price and see what your expected profit or loss is going to be. Now, this doesn't take into account implied volatility, changes to implied volatility, so you may be a little bit above or below your profit or loss, depending on what happens to implied volatility over time, because this can't predict what happens to implied volatility over time. So it's going to map this out, and at any point when you're in a profit, if you feel like you're comfortable with the profit, you can buy to close it. Okay, and you can maybe even sell to open a new credit spread, which would be essentially rolling your credit spread. So you buy to close it, and if things have gone well, you collect the profit, and then you sell to open a new credit spread with lower strikes for a higher credit, similar to how you would manage the wheel strategy. But so that's really easy to me. If things go for you, you can just buy to close and collect a profit. You can let it expire out of the money and collect the entire credit without paying any of it back. Or you can buy to close it and sell to open a new one with lower strikes for a higher credit. So when things go in your favor, managing the position is a piece of cake. When things go against you, it's not too bad, but it's not great either. So if things go against you, what you want to do, so that means in this case, when you're selling a call credit spread, that means the underlying rises in value. What you want to do is roll your position out in expiration and up in strikes for a credit. So it's similar to the wheel strategy. So if this spread becomes in the money, I need to roll out in strike or expiration and up in strikes for a credit to get myself out of the money so that I can avoid assignment. Or you could just buy to close for a loss, and that's totally fine. If you just want to do that and that fits what your goal is better, that's totally fine. But if you're trying to avoid a loss at all possible and are willing to lock up your little bit of collateral over time, then you might roll to avoid assignment. So if this spread becomes in the money, I might go ahead and roll it. And to do that, I'm going to tap on the Q spread. I'm going to hit trade. I'm going to hit view all options, because we'll roll it all as part of one trade. So we'll go to November 20th. And we're assuming our short leg is in the money here. And we're going to find our short leg and we're going to buy to close it. Okay, so I've hit select up in the top right-hand corner. And I've hit sell, or excuse me, buy, call. And I've tapped on that call and sell, call. And I've tapped on the call I've purchased. And now we need to find one. We can see how much this credit is worth. The debit we're paying to close this credit spread by tapping continue at the bottom. So we're going to pay roughly a $38 debit to close the spread. So we need to open up a new credit spread in the future with higher strikes out of the money for more than 38 cents. For more than a 38-cent credit. That way we can collect a credit by rolling our credit spread out and up. So let's go ahead and do that. And we want to keep the strikes similarly distanced, and I'll touch on why here in just a second. At least I do anyway. So we can do, let's see, what were our strikes? 294, 293. So maybe 296 and 297 is out of the money. So I can sell 296, buy 297, and overall that should give us a total credit of 6 cents. So we're buying to close our call credit spread, opening a new one with a further out expiration and higher strike that is hopefully out of the money to avoid assignment and collect more credit in the process. And I can hit review, and I can hit 1, and I can try to get a fill here. I'm not going to try to do that. I'm going to go ahead and close our credit spread. But that's how you would roll your credit spread if things got in the money. And if you keep rolling it, you can potentially get to the point where you've collected enough credit over time that even if you get assigned or if you hit your max loss for your spread, you are not going to incur a loss. What I mean by that is since we kept our strikes the same distance apart, if we get assigned, that's what we're going to lose, right? Remember, in assignment, your loss is going to be whatever the distance between your strikes is times 100. So if I get assigned my short call, I have to sell 100 at that strike. And then I will exercise my long call buying 100 at that strike. If there's 1 point between them, I'm going to lose $100. Okay, so that's our loss when we get assigned minus the credit we've received. So if we get so much credit, like we keep rolling over time and we receive $100 of credit over time, and our max loss is still going to be, the loss is still going to be the $100 because we were 1 point between our strikes, then we essentially have a free credit spread. We can't lose money on the trade anymore because we've collected so much credit that it is worth more than we would lose if we were assigned. It's kind of difficult to do because when you're rolling credit spreads, you're collecting not that much of a credit, but it's better to roll out in the future and up in strikes to avoid assignment than to eat a loss. Now, after some point, you might be pushing it too far out where you may not be happy holding up collateral for that long or whatever. But generally speaking, it's especially when you're selling in the short term, which is what we're looking at here, it gives you the opportunity to roll out really easily. I don't like buying or selling credit spreads in the long term. It's harder to predict, especially when you're selling credit spreads on something like the Qs. It's hard to predict if things are going to go down in the long term for the overall market. It's, in my opinion, slightly easier to predict if things are going to go down in the shorter term. So selling call spreads on something that you're temporarily bearish in is good, especially when you choose a shorter expiration because it allows you to roll your position easily without holding up your trade for months and months and months and months for not that much of a payoff. So you asked specifically what are the drawbacks of doing short-term credit spreads? Not much. That's pretty much how you should be doing it. IMO. Doing longer term, not really worth it so much. It's better to collect credit over and over again in the near term. And it makes so. And to come back to your question here on Hey Hero, you're asking for one credit spread where you're selling 2 puts. The ideas that I've talked about looking at the Qs as a call credit spread apply exactly the same to a put credit spread. Your max loss, the way it's calculated, is the same. The way your roll is the same, except for you're rolling out and down. And there's not a disadvantage necessarily to doing short-term credit spreads. In fact, that's usually best because you're going to have theta that degrades the value of your short leg quickly, which is good because that's how you make money with credit spreads. And let's see. And then he also asked about the credit spread number 2. It says selling 1 put and buying 1 call. And I'm not exactly sure what you mean by that because if you're looking at a credit spread, you're never going to be selling a put and then buying a call. Those are 2 bullish positions that would result in an overall very high positive delta. So that wouldn't be a credit spread, but maybe you're talking about a call credit spread, which is what we just discussed. So definitely I would recommend doing credit spreads in the short term. I recommend doing them out of the money to increase your probability of success. I recommend having a thesis on the underlying that gives you a justification for why you have a certain market outlook. And then I'd also encourage you to look at an options profit calculator and see what the profit and loss of that credit spread would be given certain dates and certain stock prices. That's how I take a look at these credit spreads and give yourself an edge through implied volatility and the fact that you are selling credit spreads because you make money as time passes. If it's out of the money, you have a negative or positive theta, so you make money as time passes. So your break even is going to be above the current stock price because remember, we just want the stock price to stay below your short leg, which means your stock price is going to have some room to go up and you can still be right. That's why it's super high, far out of the money call credit spreads or put credit spreads have a high probability of success is because you just want it to stay below your short leg pretty much. And so that means if it's way, way out of the money, the stock price can move quite a bit and you can still win the trade essentially. So they have a high probability of success, but those high probability of success trades do have high max losses. So in my opinion, it's better to have a pretty strong thesis and still sell out of the money, but not so far out of the money that shows that you're insecure about where the underlying is going. You should have a pretty good idea, but that is what makes it difficult to trade these as compared to the wheel, is because you have to have a strong thesis on where the underlying is going, especially a strong thesis in the short term. And that is difficult. It is difficult to analyze that subjectively or objectively, excuse me. So that's what makes it so difficult. And that's why I don't trade these as much as I trade the wheel because the wheel is just so easy. It is easy, although I've had plenty of success with these. And I much prefer credit spreads over debit spreads because you can roll credit spreads for a credit, and they are a positive theta strategy when implemented in the textbook way, which is out of the money. I think that about wraps up all my thoughts on that right now. Wish you the best of luck, Joe. Thanks for your patience, and I hope this gives you a little bit of insight into how to give yourself an edge and how to trade these the Atom way. I wouldn't say properly, but I think it's properly, but other people have different ways to implement different things. So the Atom way. This is the way you can do it the Atom way if you want to do it. Okay. Best of luck, man. Catch you later.